How does a company that loses money every single time a customer uses its product get valued at $47 billion? It sounds like a joke, but right now it is the reality of the most hyped industry on earth. Silicon Valley is currently burning through tens of billions of dollars every single quarter. They are buying up computer chips like they are the last drops of water in a desert. They are building data centers so massive they require their own nuclear power plants, and they are giving you access to the most advanced technology in human history for a measly $20 a month. A price that mathematically guarantees they are bleeding cash with every single prompt you type. But instead of panicking, Wall Street is throwing even more money at them. Investors are cheering. The media is calling it the next industrial revolution. But if you look closely at the math behind the curtain, a terrifying reality starts to emerge. We are not watching the dawn of a new utopia. We are watching the biggest casino in the history of capitalism, and 99% of the players at the table are mathematically guaranteed to go bust. So how did the smartest people on the planet trap themselves in a game they cannot win? And more importantly, who is actually walking away with all the cash while everyone else burns? To understand the absolute insanity of what is happening right now, we have to go back to late 2022. The moment generative chatbots launched, the world completely lost its mind. Overnight, the entire global economy decided that artificial intelligence was not just a tool but the only thing that mattered. A massive gold rush began. Suddenly, every single tech company, startup, and random guy with a laptop realized one simple truth. If you put the letters A and I next to your company name, investors would throw millions of dollars at you without asking a single question. It was pure financial magic. The norm became absolute chaos. You had companies that made software for scheduling dental appointments suddenly pivoting to become AI-driven dental synergy platforms. Their valuations skyrocketed. Venture capital firms completely panicked. They suffered from a massive case of fear of missing out. No fund manager wanted to be the idiot who missed out on the next Google or the next Apple. So they opened their checkbooks and started writing blank checks to anyone who could say the word neural network. This was the honeymoon phase. The news cycle was relentless. Every single day there was a new breakthrough, a new startup raising $100 million, a new billionaire minted on paper. The narrative was perfect. Artificial intelligence was going to cure diseases, write code, drive our cars, and do our laundry. And because the potential market was technically every human being on Earth, the valuations made sense to them. If you are going to capture a $10 trillion market, what is a $50 billion valuation? It is just a drop in the bucket. Right. But here is the problem with honeymoon phases. Eventually somebody has to pay the bills. And the bills in this new industry are unlike anything the world has ever seen before. In a normal software business, you write the code once and you sell it 1,000,000 times. The cost of adding one new customer is basically zero. That is why software companies have profit margins of 80 or 90%. It is a beautiful, highly profitable business model. But AI is not normal software. AI is heavy machinery disguised as code. Every single time you ask a chatbot to write a poem about your dog or generate a picture of a cat riding a skateboard, an actual physical computer server somewhere in a massive warehouse has to do heavy mathematical lifting. It consumes real electricity. It generates real heat. It requires massive cooling systems. And most importantly, it requires specialized computer chips called GPUs. These chips are not cheap. They cost tens of thousands of dollars each. And you do not just need one. You need clusters of tens of thousands of them working together just to train a single model. So the normal economics of software are completely broken here. You are not writing code once and selling it infinitely. You are burning raw computational power and electricity every single time a user hits enter. It is like running an airline where you offer unlimited flights across the globe for $20 a month, but you still have to pay for the jet fuel, the pilots, and the maintenance for every single trip. The more customers you get, the more money you lose. It is a death spiral disguised as hyper-growth. And this is exactly the loophole that the entire tech industry is desperately trying to ignore right now. They are trapped in a cycle where they have to keep lowering prices to gain market share, but their underlying infrastructure costs are rising exponentially. Let us look at the actual numbers because the math is absolutely staggering. The biggest tech giants in the world are currently pouring over $100 billion into capital expenditures just to build out this infrastructure. They are digging massive holes in the ground, filling them with concrete, steel, and the most expensive microchips ever manufactured. They are essentially building the most expensive casinos ever conceived. But who are the gamblers? The gamblers are the thousands of startups who rent this computing power. These startups take venture capital money and immediately hand it over to the tech giants to pay for server time. They use that server time to train their models, and then they try to sell subscriptions to you and me. But consumers are exhausted. Businesses are hesitant. The adoption rate of paying $20 a month for a chatbot is not growing fast enough to cover the massive hole being dug by the infrastructure cost. The math simply does not add up anymore. You have an ecosystem where step 1 is raise $1 billion. Step 2 is spend $900 million on computer chips and electricity. Step 3 is sell a subscription for $20. Step 4 is pray for a miracle before the bank account hits zero. This is not a sustainable business model. This is financial suicide on a macroeconomic scale. But nobody wants to be the one to stop the music. If a big tech CEO suddenly announces they are cutting back on spending, Wall Street will instantly punish them. Their stock price will crash. The media will declare them a dinosaur. So they have to keep playing the game. They have to keep smiling for the cameras and pretending that the $20 monthly subscriptions will eventually cover the $100 billion server farms. They are all strapped to the same rocket ship and no one knows how to hit the brakes. Think about the California gold rush of 1849. Imagine thousands of people leaving their homes, borrowing every cent they can and rushing into the mountains to dig for gold. They are the AI startups today. They are absolutely convinced there is a fortune buried just beneath the dirt. But here is the catch. The gold is incredibly hard to find. Most people are just digging up dirt and going bankrupt. However, to even start digging, they are forced to buy a very specific type of pickaxe. And there is only one guy in the entire world who sells this magical pickaxe. He charges whatever he wants. He does not care if you actually find gold or not. He gets paid up front in cold hard cash before you even swing the tool. In our modern casino, that guy selling the pickaxes is Nvidia. They are not playing the casino games. They are selling the slot machines to the casino owners. Every single dollar of venture capital raised by these ambitious startups is immediately handed over to buy compute power. It is an incredibly efficient pipeline, moving money from the pockets of optimistic investors directly into the bank accounts of hardware manufacturers and massive cloud providers. But why does this madness keep escalating? Why do the biggest tech companies in the world continue to dump billions into a furnace? The answer is pure, unadulterated fear. It is a corporate arms race, and the weapon of choice is the graphics processing unit. Google is terrified that Microsoft will make their search engine obsolete. Microsoft is terrified that Amazon will dominate the enterprise sector. Meta is terrified that Apple will control the future of mobile interfaces. No one can afford to stop digging, because the moment you stop, your stock price collapses and your competitors crush you. It is a game of chicken played with hundreds of billions of shareholder dollars. So they just keep multiplying their budgets. If a competitor buys 100,000 chips, you have to buy 200,000. The cost of entry into this game is no longer measured in millions. It is measured in entire data centers and dedicated power grids. The capital expenditure numbers are becoming entirely detached from reality. We are seeing companies casually announce $50 billion spending plans while generating a fraction of that in actual revenue. This creates a massive bottleneck. The entire ecosystem is built on the assumption that eventually normal people and regular businesses will pay enough money to cover these astronomical costs. They are betting that one day the magic pickaxe will strike a vein of gold so massive that it pays off all the debt. But right now the revenue is just a tiny trickle compared to the roaring waterfall of expenses. We are currently stuck in a massive holding pattern. Startups are burning their seed money. Big tech companies are subsidizing the losses just to keep users locked into their ecosystems. And the gap between the money going out and the money coming in is widening every single day. The loop of hype fuels the loop of spending. You announce a new model, the stock goes up, you use the stock to buy more chips, you announce another model. But the fundamental law of mathematics cannot be ignored forever. At some point the bill comes due. The problem with this loop is that it requires an infinite supply of fresh capital. And capital is never infinite. Let us break down the unit economics of a single query. When you type a complex prompt into one of these cutting-edge models, it requires multiple layers of computation. The system has to process your words, access its massive neural network, generate a response, and send it back to you in milliseconds. Behind the scenes, a server rack is running at maximum capacity, drawing immense power. The cost of that single transaction might be a few cents. That sounds cheap, right? But multiply those few cents by hundreds of millions of daily active users asking dozens of questions every single day. The operational costs explode into the billions. And remember, you are only paying $20 a month. Many users are paying absolutely nothing on the free tiers. The companies are eating that cost because they are desperate to build a monopoly. They are basically handing out free sports cars and hoping they can eventually charge you for the cup holders. This strategy only works if the music never stops playing. It relies entirely on the assumption that investors will continue to fund the losses indefinitely. But Wall Street is not known for its infinite patience. Historically, when the gap between the hype and the actual revenue gets this wide, a reckoning is always on the horizon. The investors providing the cash are going to start asking very uncomfortable questions. They will look at the balance sheets and realize that the magical artificial intelligence revolution is currently the most capital-intensive low-margin business model ever created. And when they realize that the return on investment might take a decade instead of a year, the panic will set in. The venture capitalists will stop writing the blank checks. The startups will run out of runway. And the massive tech giants will be forced to explain to their shareholders why they spent the equivalent of the gross domestic product of a small country on server farms that cannot turn a profit. The breaking point is pure mathematics. It is a moment of brutal clarity. One day, a very boring accountant on Wall Street is going to look at a spreadsheet and ask a very simple question. Wait a minute, where is the actual profit to pay for all of these $600 billion servers? That is the pin that pricks the bubble. The moment that question is asked out loud, the illusion shatters. The music stops. The venture capital money that was flowing like a massive river suddenly dries up completely. The investors who were terrified of missing out are now terrified of losing everything. They slam their checkbooks shut. And this is when the bloodbath truly begins. The startups who rely on burning that venture capital cash to survive will starve to death almost overnight. They do not have real revenues. They only have burn rates. They cannot afford the compute power anymore. They cannot afford the electricity bills. They will be forced to shut down their servers and fire their incredibly expensive engineers. The billions of dollars of paper wealth will evaporate into thin air. A startup valued at $20 billion on a Monday will be desperately trying to sell its office furniture for pennies on a Friday. The dominoes will fall incredibly fast because the entire system is hyper-connected. When the startups die, they stop renting server space from the big tech companies. The big tech companies suddenly realize they have massively overbuilt their data centers. They cancel their giant orders for new microchips. The hardware companies who thought the party would never end watch their revenue projections fall off a cliff. The stock market, which has priced all of these companies for absolute perfection, will experience a brutal and violent correction. Trillions of dollars of market capitalization will be wiped out in a matter of weeks. The news cycle that used to cheer for the artificial intelligence revolution will immediately pivot to writing obituaries for failed companies. Panic will replace greed. We have seen this exact movie before. History is simply rhyming again. Look back at the year 2000 and the dot-com crash. Everyone knew the internet was the future. Everyone knew it was going to change human civilization. They were absolutely right about the technology. But they were entirely wrong about the timeline and the price. Back then, you could put a .com in your company name and instantly become a millionaire on paper. Investors threw billions at companies that had no business plan other than buying Super Bowl commercials. But when the market woke up and realized that regular people were not going to magically generate infinite profits for these websites, the bubble popped. Trillions of dollars vanished. Famous companies like Pets.com went spectacularly bankrupt. But the internet itself did not die. The crash simply cleared out the garbage. It burned away the hype so that the real winners like Amazon could eventually build sustainable businesses from the ashes. Artificial intelligence is going through the exact same cycle right now. The underlying technology is absolutely real. It will eventually change how we work and live. But right now, 90% of the companies promising you a revolution are just burning cash in a giant furnace. They are digging for gold in an empty desert and hoping you will pay for their shovels. The hype has completely detached from the economic reality. The ultimate macroeconomic lesson here is crucial. In any financial gold rush, the greatest risk is never the technology itself. The greatest risk is the massive premium you are paying to enter the casino. Do not be the naive gambler throwing your life savings at a table where the math guarantees you will lose. Always look at the cash flow. Always ask who is actually making the real money right now. If a business model relies on an infinite supply of eager investors and endless media hype, it is mathematically guaranteed to collapse under its own weight. Protect your capital. Do not get caught holding the bag when Wall Street decides to turn off the lights and close the casino doors. If you want to survive the next market wipeout, make sure to subscribe to the channel and leave a comment down below. Because in our next video we are going to expose a completely different financial disaster. We are going to look at the massive ticking time bomb hiding inside the commercial real estate market that could bring down the banking system all over again.